I place 9 different mutual fund holders in the big boss house. Whoever sells last leaves the house with 80 lakhs. There are many hazards placed that will entice you. If you are tempted and sell early, it is game over. It can take a long time, it can take 10 years. Whichever investor sells last wins 80 lakhs. There is an entry price of 10 lakhs to play this game with Big Boss. I chose the Flexicap fund category because it gives the fund manager the flexibility to invest across large, mid and small caps. We'll find out what kind of an investor wins this game. These 9 funds are those that have been able to beat the category average performance. As I said, there are many traps in the house. Most often, they will scare you into an eviction, or it can entice you to sell the funds for a small profit. Here is the first. The house carries an article that warns of a sharp 25% market correction if the government of the day loses the election next year. This is indeed scary, and some of them may sell and exit. If you missed this notification, here is another one, an enticing one. This is an extreme opposite view which expects markets to rise 50% over the next 5 years. Both published around the same time. Two very divergent opposite views. That's how markets are made. Because when somebody sells for a reason, somebody else buys for another reason. So what's the greater truth? This chart shows the market performance before, during and after elections. In 2004, the market crashed 12% in 1 month after the election, post the defeat of the ruling NDA government. In fact, during that year, the market was down as much as 35% from the top. If you zoom out, you will see that this is a small blip in the overall journey of the market that rewards investors between 12 and 14% annualized over a very long 20-year period. There is no way of knowing in advance what is going to happen to the market. One cannot gamble and sit out hoping to buy again. The best days in the market comes just after the worst days. If you sell in anticipation of a market crash and assume it does occur, the likelihood of you to re-enter the market before it rebounds is very low. This may compel you to repurchase assets at a higher price than the ones at which you have sold. To make mega money, there must be big fear in the market and valuation has to be low. This combination does not happen often. It happens once in 5 years or 10 years, and you got to take full advantage of this opportunity. Many investors tend to sell as soon as they make a little profit, thereby remaining small investors always. They can neither resist the temptation to book profit nor give time to compound. Once their investment grows to any decent amount in their eyes, there's a strong urge to encash it, take the profits out. They fall for what is referred to as shiny object syndrome. It is being in a state of continual distraction. They believe there's something more exciting they might be missing out on, so they keep jumping, gathering no mass. Do you need money quickly? Do you want to get rich? Then join this band. Consider this. Over the past 30 years, long-term investors in mutual funds have consistently made money. Yet, the total number of investors in this reliable avenue is only 4 crore Indians. On the flip side, the crypto space has seen 18 crore investors, despite the fact that most of them have experienced losses. 10 crore Indians have lost money in gaming, and a striking 90% or more future and option traders end up losing money. Even in the most literate state, the spending on lottery tickets surpass the total size of equity mutual funds today. It's almost a guarantee that you'll lose money in lottery. Why do people still go after avenues where it is almost guaranteed to lose money? The answer lies in these two hazards in the big boss house. So to be a successful investor, he has to undertake this task and overcome these obstacles. In a confession room conversation, Big Boss did give away a secret. In investing, mistakes are inevitable. The key is minimizing them. One common error is reverse asset allocation, where despite knowing markets go in cycles, investments are often made against conventional wisdom. For example, today mid-caps have delivered 22% annualized return for the past 10 years. If you see the investor allocation today to mutual fund, all their funds are going into mid-caps and small caps which are already inflated. That's the behavioral problem in investing. We chase assets that have done well in the past, whereas asset allocation should be counter-cyclical. When the cycle is exuberant, be cautious. When it's pessimistic, be aggressive. To succeed as a long-term investor, it's better to be part-time, Full-time investors often struggle with impatience, expecting quick returns. Being a part-time investor helps, especially if you have another profession. It allows you to be less stressed about daily market changes and approach investments more patiently and strategically. In conclusion, the journey of our 9 investors in the Big Boss investment house mirrors the real challenges faced in the market. The last investor is the one who sells upon reaching his financial goals for which he has invested. He is able to undertake the long journey because his choice of funds align with his risk score and time horizon. The list of top 9 Flexicap funds have managed to withstand all the short-term turmoils and still generate returns between 17 and 23%. 10 lakhs invested 10 years ago is today worth 50 lakhs at the minimum or 83 lakhs on the maximum. If you enjoyed this content, please consider liking this video, sharing it with your friends, and subscribing to this channel.